is déjà vu all over again, managing problem loans in the 2020s. Our speakers today are Dean Snyder, Doug Skinner, and Lee Kidder from AFS. Before we get started, there are a few housekeeping items. We are recording today's session and therefore all lines have been muted. We do encourage questions. You can use the Q&A feature to ask questions, or if you would like to ask a question live, use the raise the hand feature and we will unmute your line as soon as we are able to. Tomorrow, you will receive an email with a link to listen or download the presentation. Thank you for joining us today. Dean?
Thank you, Renee. Good afternoon to everyone, or good morning, depending on where you're joining from. Today, we are going to be starting, I think, a series in the dialogue around problem loan management. As we said, déjà vu all over again. We've certainly, in the banking business, we've certainly been through multiple credit cycles, and unfortunately, with COVID, we're experiencing another significant one. So in today's session, we're going to show you some of the data that AFS's Business Intelligence Group is tracking about market trends with current credit quality issues. And then we will talk about some of the operational processing challenges that banks are facing due to the downturn in the economy. And then we will also talk about what AFS and through AFS Vision and its products can provide in terms of support for dealing with the problem loans in this current environment. We will be having some polling questions interspersed through the presentation. We want to encourage this to be interactive. So as Renee said, you're able to submit your questions as we go. We will be monitoring them during the webinar, and we will attempt to address those as we get them, or possibly through a follow-up. And again, at the end, we may be able to allow just live questions, time permitting. So Renee, let's go to the next slide, please. And again, we anticipate this being a series because there's a lot to talk about, and certainly a lot will be evolving with the market, dealing with problem loans in different aspects. So we will obviously be able to present you some of the market data, showing you what the impacts have been from COVID-19. And we recognize that, most of our banks have not had to deal with a large number of non-performing loans, in quite some time, back to the previous financial crisis. And lenders have adjusted, staffing, business, and so forth, and support capabilities as a result of the positive economic climate that we've had the past several years. So now there's going to be a change back, and we'd like to talk about what some of those impacts are going to be and how you're dealing with it, and a chance for you to ask questions and share, and we can share with each other things that you're experiencing and possible solutions and ways to mitigate some of these issues. So as you know, we've developed these webinars to deal with different trends. We've certainly had one about COVID starting back early in the year. We've been running a series on SOFR and the transition for LIBOR. So today we're going to talk more about the current economic conditions with the loan market and problem loans. Again, we'll schedule live questions as we go to help encourage some participation from you. So now what I'm going to do is turn this over to Doug Skinner, who's the director of our Business Intelligence Group at AFS. And most of you should know that the BI group collects an enormous amount of valuable data from the major banks around the US, and the BI group is able to take that data and provide some pretty meaningful, significant analysis. And I'm going to let Doug go ahead and share some of that with you today. Doug?
Thank you, Dean. What we want to do first is give you a sense for where non-performing loan levels are at the moment, but also give you some historical context, which you can see here, for where those levels could go based on prior recessions. So you can see the large blip in non-accruals, obviously during the Great Recession, then the smaller blip there in 2015-16. That was an isolated energy crisis, you may recall. But again, we can always look at history to get an idea of what may happen going forward. So here we've plotted 4 key risk indicators. There are 2 measures of short-term delinquencies, a measure of long-term delinquencies, and non-accrual loan levels over time. So I'll start first with the short-term delinquencies. So that's like the blue line on your screen. So that's the percentage of loan outstandings that have been running about 1 payment behind. It's been below 50 basis points for nearly 10 years. So as we said, not a lot of issues for quite some time. But then once the pandemic took hold in March, they spiked quickly, really almost tripled to about 150 basis points of total loans. Since March, we've been on sort of a yo-yo month to month, and what's been happening is delinquent loan balances are being buffeted by some offsetting forces, which I'll talk about. On the one hand, you have the pandemic-induced state shutdowns that rippled across the country. Then they were followed by gradual reopenings, but then in some cases, states were forced to dial back those reopenings. Those stops and starts to local communities and their businesses have certainly weighed on borrower performance. On the other side, though, you have the extensive fiscal support that was provided by the US government. So things like the Paycheck Protection Program, the moratorium on evictions. There's been very liberal and widespread use of payment deferral programs, which has certainly helped. You've had enhanced unemployment benefits. All those actions taken together have very clearly helped. But what they've also done is make it really difficult for banks to get a true sense of borrower credit quality, and that kind of continues today. The other data point we track closely is the level of non-accrual loans. That's the red line. So again, these would represent borrowers that have already defaulted, where P&I is 90 days or more past due, or payment in full is not expected. So the bank has gone ahead and reversed accrued and unpaid interest and placed the loan on non-accrual. That is certainly a key indicator of problem loans. That's risen about 40% since the beginning of the downturn. And in fact, non-accrual balances rose 18% just in the last month. So for context, you can see that during the last major downturn, the level of non-accruing loans reached well above 3%, and as importantly, stayed there for quite some time. So as you know, problem loans take a long time to resolve. In terms of how bad things will get this cycle, really remains to be seen. It depends on a lot of factors, including certainly the availability of a vaccine or other treatments. Always depends on consumer confidence. It depends on what banks do as these deferrals expire. Depends on if there's going to be other stimulus, things like that. So it's going to take a while yet to sort itself out. But fortunately, we can get some insight into what the banks are planning for. And we're going to show you that here in just a couple of minutes. So if we go ahead to the next slide, please. So one of the things all banks are doing now, or certainly they should be doing now, is aggressively going through their loan portfolios and re-rating their borrowers. So certain industries are now particularly high risk, so such as maybe accommodation and food services, right? That's where all your hotels and restaurants are. Any leisure type activity, including arts and entertainment. Anything tied to discretionary spending in many cases has probably already been downgraded at least a notch, if not more. This data here shows a trend in adversely rated commercial credits. So the federal regulators basically identify 4 specific risk grades that they associate with a criticized loan, and all banks, regardless of their size or their sophistication of their risk rating methodology, they all recognize those same grades in their own borrower risk rating scale. So you can see levels of criticized loans have been rising quickly in 2020. We're at about 8.5% right now. So that means about 8.5% of total outstanding commercial loan balances have an adverse risk rating. Criticized loans have risen already about 50% since the beginning of the downturn. So so far, though, most of the increase is in the earliest stage category, what they refer to as special mention. So that's I guess, one positive you could draw from it. But when you look at this from a historical perspective, again, the CARES Act and the related actions seem to have slowed the pace of migration so far. So again, the question is, what happens from here? You can see during the last downturn, criticized loans peaked at over 20% of total balances. So that's 1 in 5 loans, basically, which is not sustainable, right? So criticized loans remained at that level for over a year, and then took many more years to normalize again as banks worked out the problem loans. So banks are still hoping that, given the forbearance measures they've taken, combined with the fiscal stimulus programs, that will be enough to bridge most of the borrowers through the crisis. Certainly some businesses have no doubt already closed permanently, but right now they're really trying to figure out what loans are still viable as the initial deferral periods expire. But as far as any final resolution, certainly when we might start to see materially higher charge-offs, for example, that probably won't happen until at least the fourth quarter, more likely sometime in 2021. Next slide, please. So again, with all the uncertainty still about the financial outlook, one thing we can look at is how much money have the banks been setting aside to cover future losses. And this slide here shows the last 6 quarterly provisions a number of major banks have made for future loan losses. And what it's showing is banks are very aggressively building their loan loss reserves. Keep in mind, this is also coming in the first year of CECL, when they have to account for expected losses, not realized losses like they did in the past. So modeling that in the middle of a pandemic is no doubt quite a challenge. But basically what this chart shows you is that most major banks have quadrupled loan loss provisions from levels a year ago. So a clear sign they are expecting credit conditions to worsen substantially and loss rates to begin to rise in the months ahead. Now, in some ways, charge-offs have been rather light so far. Loss emergence was light in the second quarters, mostly in smaller balance commercial loans and to borrowers in sectors suffering kind of the first order effects, if you will, from the pandemic, so restaurants and hotels. But again, I haven't seen charge-offs take off dramatically quite yet. Now, in about a month, the banks are going to report third quarter results. And right now, what we're hearing is that projections for third quarter reserve builds are going to be actually far lower for the regional banks. And that's because most of the large, certainly publicly traded banks would have been looking to kind of put questions about their loan loss reserve adequacy behind them last quarter. They would have been finishing up their stress testing. That's why you saw such dramatic reserve builds in the first and second quarter. More recently, we've started to receive some more favorable economic news, some more cautiously optimistic news about vaccines and therapeutics. So we'll see what banks do when they start announcing earnings in about a month's time. Next slide, please. So throughout the summer, we've all been watching this massive experiment, if you will, in forbearance play out. As an industry, we've never done or seen anything quite like it before. So What that means is nobody really knows how it's going to turn out. So for now, at least, the true financial condition of many borrowers and certainly the asset quality of many banks is kind of in limbo. What we've also seen is that there was no universal way in which banks approach deferrals once the regulators first started really encouraging the practice back in April. In general, most of the initial commercial deferral programs offered 3-month or 6-month periods. Some banks simply granted deferrals to anyone that asked for one. One banker told us they were handing them out like candy. Other banks asked for more proof or justification that a deferral was really needed and was in fact related to COVID-19. Still others asked for maybe new conditions like more collateral or even upfront payments. Sometimes we saw the deferral apply to interest only, sometimes to principal, sometimes to both. So again, the practice has really varied widely. I'm getting a little feedback, so maybe one of my other panelists might want to mute if that would help. So in the last couple of months, we've conducted surveys on the topic, and we wanted to share some of those results with you here. In July, we asked what percentage of your commercial borrowers were initially granted deferrals. And you can see by the chart on the top left, 40% of the respondents granted deferrals on over 10% of their commercial loans, and nearly 3/4 of the respondents had granted deferrals on more than 5% of the commercial loans. So this was interesting to us in the sense that we knew deferrals were being used liberally and for retail products like mortgages and auto loans, but we learned that the practice was also being widely applied in the commercial space as well, and maybe more so than a lot of people initially thought. So then last month, with many of the initial deferrals starting to approach their expiration, we posed a follow-up question, and that was, what percentage of your commercial borrowers that receive payment deferrals do you expect will be granted a second deferral? And this time, the most popular answer was less than 25% of the borrowers we think will be granted a second deferral. About 60% said that. Then about a third said 25 to 50 would be granted a second deferral. So based on that and what we're hearing, we're actually expecting a fairly significant drop in deferrals after that initial round. This is also supported by some of the bank disclosures they're making and management comments at recent conferences. So we're seeing and hearing about banks are starting to pare back deferral programs, but certainly if there was, say, a resurgence in the virus or some of these other favorable economic trends start to go sideways, obviously things could change again. Next slide, please. Another factor that I referred to that's really masking true credit conditions that I wanted to mention is this record amount of fiscal stimulus that was injected into the U.S. economy back in mostly in April and May. That has definitely served its purpose. It's provided a lifeline to thousands of businesses, but at the same time, it makes your life difficult in the sense you're trying to fully gauge how many businesses are eventually going to default anyway, and what you need to be doing to prepare for in terms of workloads and volumes and staffing and that sort of a thing. One thing we've observed, though, that's illustrated here, some of the stimulus programs have benefited some industries and borrowers more than others. So take, for example, the Paycheck Protection Program. Here's a program where lenders have successfully issued over $500 billion to businesses struggling to the pandemic. However, nearly half of the funds went to just 4 industries. So they're kind of at the bottom and up: healthcare, science and technology, construction and manufacturing. That's where a lot of the money went. So not surprisingly, criticized loan levels in those industries, as you can see from the illustration, have remained fairly manageable. The opposite goes for commercial real estate, energy, agriculture. We mentioned hotels, restaurants. There's actually a very strong inverse correlation we're seeing right now between the level of the fiscal support provided to an industry and the current percentage of criticized loans, which obviously makes a lot of sense. So I think that brings us to our first poll question. If we could go ahead and bring that up. And so our first poll question is your bank hiring or reassigning staff or maybe repurposing staff members to work on an anticipated increase in problem loans over the next few months? So you can select more than one answer here. You can choose between yes, loan operations, yes, in the line, maybe in the line of business, credit risk management, or in the workout group, or no and not at this time. So again, not just if you're thinking about hiring, but also reassigning or repurposing people. So we'll take just a minute here and compile those votes. And Renee, whenever you want to show the results, we'll go ahead and do that. Okay, so you should be able to see the results on your screen. The first, I guess, most popular answer is no, about 50% there. That's perfectly plausible. It's still a little bit early, as we said. There's a long way to go to have problem loan levels reach what they were in the last downturn. The federal government's actions have certainly mitigated a lot of the initial increase, so that makes a lot of sense, and budgets are already tight given interest rates at the zero lower bound and everything else. So other than that, we have kind of a wide range of answers across all areas, certainly workouts, credit risk management leading the way, so that all makes sense. Okay. So thank you for that. I think we're going to transition now to the next section. We're going to turn our attention to some of the potential operational challenges that are often presented by increases in problem loans. And for this section, I'm going to turn it over to Lee Kidder.
Thanks, Doug. So good morning or good afternoon or perhaps even good evening, as the case may be. And thank you all for tuning in. We at AFS view the potential scenario around problem loans the same way we might view an approaching tropical storm, which has the potential and likelihood to become a strong and dangerous hurricane, even though it might also dissipate or veer back out to sea. So the prudent course of action is to be aware and up to date on its course and prepared for it. Hope for the best, but prepare for the worst. And that's why we're presenting this webinar today. You just saw the slides, the several warning signs that indicate a potentially serious flood of non-performing commercial loans could hit banks in the next few months, the first such storm in more than a decade. So what I want to discuss for the next several minutes is how to be prepared operationally to deal with them. We've grouped the points we want to present into 4 categories, which represent what we mean by the term operational, namely those issues that concern the overall loan processing, accounting, record keeping, and reporting of commercial loans. We won't be getting into issues that affect the front office line of business, workout strategies, or customer relationships. So think of this as a checklist of the areas your operations units should probably address to make sure you're prepared. Concerning the overall approach to processing non-performing loans, perhaps the most important issue to address is coming to an understanding with the different segments of your bank about organizational roles and responsibilities in handling them. Who's going to have responsibility for what steps in the process? Who will make decisions about how to allocate payments? Who will own the asset? Does it get transferred to a special assets unit or remain on the primary loan servicing system? Making these distinctions clear beforehand will remove a lot of confusion and inefficiency later on. The next important factor, of course, is the availability of staff who have experience and skill in dealing with problem loans. Considering that the last problem loan spike was over a decade ago, you should be thinking now about possibly reassigning or hiring skilled people before the spike becomes very real. So I was pleased to see that, as in the polling question just a minute ago, 50% of the participants indicated that somewhere or another in one or more of the units in the bank, they are looking at their staffing levels, but 50% said no, they are not doing that yet. Third, understand the strengths and potential weaknesses in your loan servicing system. Consider where in your processing workflow there may be gaps in automation that might create an impediment to smooth and rapid handling, whether robotics or APIs could be implemented to streamline processing and avoid a backlog of manual workarounds. But be careful as well to check whether any existing automation features could cause problems. For example, if your system puts loans on automatic non-accrual after 90 days of delinquency, you may want to disable that to provide you with more flexibility. AFS, of course, stands ready, as always, to assist on a consultative basis with any issues involving process automation and workflows. We'd be remiss in talking about problem loans without mentioning the environmental context surrounding them, and in particular, the ramifications involving COVID-19. I suspect, for example, that nearly all of you are listening in from your own homes, which in itself could be a source of difficulty in dealing with problem loans. In those cases where moving loan documents electronically or accepting e-signatures might pose problems and slow down efficient processing simply because people aren't physically in their workspace. The CARES Act included several provisions to help businesses that were in trouble because of the pandemic. Section 4013 in particular gave banks the option to make certain modifications to loans as a result of COVID-19 without requiring that they be designated a TDR, troubled debt restructure. These modifications could include forbearance arrangements, interest rate adjustments, repayment plans, and the like, which could serve to delay or defer payments. They would remain in place for the remainder of the life of the loan, and importantly, would not have an adverse effect on the borrower's unrelated credit standing. The issues here, as Doug indicated, involve how you will account for that deferred interest when the time comes. Capitalize it or not, re-amortize it over your loan's term, or some other creative method. These modifications in and of themselves could be considered problematic depending on how sophisticated the functionality of your servicing system is, but can also create confusion and extra work if the loans continue to deteriorate and further modification is necessary. In essence, they could have a double whammy on problem loan management, since they could simply delay loans from going into non-performing status, and at the least consume resources and exacerbate their availability to work on other issues. Consider the PPP program, which added 5.5 million new loans to issuers. While the great majority of PPP loans on your books are likely to be forgiven and dispatched without issue, you may well end up with some that are not forgiven, either entirely or in part. If that's the case, those companies could be very vulnerable to default or bankruptcy as the pandemic and economic uncertainty continue, especially if Congress fails to enact any additional stimulus. Be prepared, therefore, to handle these cases separately, since their circumstances are likely to be unique, and be prepared to provide reams of documentation to the SBA if necessary. And in any of these cases, remember that they may well take away resources that would otherwise be available for other non-performing loans. Unless Congress approves an automatic forgiveness for PPP loans under $150,000, resources are going to be consumed a great deal by the forgiveness process for all of those loans, which in numerical terms account for 87% of all the PPP loans are under $150,000. In June of this year, Barlow Research conducted a survey in which 70% of both small business and middle market borrowers do expect to get assistance from their lenders on the forgiveness process. And you may have noticed an American Banker story yesterday about frustration being expressed among lenders over the slow pace and lack of guidance from the SBA on the forgiveness process. Now, as Doug said, the implementation of CECL this year poses another indirect pressure on problem loan management. The CARES Act allowed banks to defer compliance with the CECL standards until at least to the end of 2020. It's unknown whether many banks took advantage of that grace period, since many had already begun to abide by CECL, but its timing simply added to the burden of having, in most cases, to increase loss provisions in the midst of a pandemic and recession without a clear sense of whether those amounts would be high, low, or otherwise. And finally, with the coming switch from LIBOR to SOFR as a base index rate, consider how well your system will be able to adjust or reconfigure terms for loans that are booked on SOFR, which has 4 different methods for calculating rates, but would go into non-performing or non-accrual status. Now, around accounting policies and procedures, we don't believe that they are likely to be overly problematic, since we expect that servicing systems can handle the basic accounting differences between accrual and cash accounting. Nonetheless, a number of situations are going to require decisions to be made that will affect whether accrual or cash accounting comes into play. Should a delinquent loan go into a non-accrual before 90 days, for example? And if so, how should the status code, which determines how payments are allocated, be set? If one loan for a customer goes into non-accrual, do you or do you not put any of the other loans for that company into non-accrual? As I mentioned earlier, you may want automatic non-accrual disabled in certain, if not all cases. Based on our own client base, most banks do not use that feature, even though it's available. Now, once a loan has gone into non-accrual, the number of decision points around payments and recovery magnifies, and with them the possibility of erroneous accounting or record keeping. How to apply any payments received after non-accrual can become very complex very quickly, and you should be prepared to separate the accounting that the delinquent customer sees in bills and statements from the quote actual accounting that gets posted to the general ledger. Other cases will require a decision about whether an incoming interest payment should be applied instead as a payment to principal, which I believe is the prevailing policy at many banks, or whether that particular customer has the wherewithal to return eventually to full accrual. In cases of bankruptcy or court judgments, there may be special instructions about where to apply payments, or even to write down the principal amount. If a loan has already been fully charged off, for example, and a payment happens to arrive, you'll need to be able to allocate and record that payment in some category for general ledger purposes. I bring up these various potential problem issues because the real issue with them is not likely to be accounting per se, as much as it is your system's capability to keep track of all the different transaction types and strands of information that you'll have to keep separate for record keeping and reporting. I want to get next to those issues that are likely to arise in record keeping for problem loans. But before I do, we have another polling question we'd like to pose to participants now. So go ahead with that question, please. So this issue has been mentioned. Does your bank have a separate special assets or loan workout unit that assumes responsibility for problem loans? So please select just one of these answers. Yes, we do that for all of our non-performing loan types. Yes, we do that for certain non-performing loans, or no, we don't transfer those loans at all in responsibility. So we'll take a minute to put our answers up here. And if we're ready, could we see the answers? Well, this is not unexpected a bit. In 76% of the cases, all non-performing loans, regardless of their type, get a special asset transfer for them. Only 12% of you do that for a selected amount of loans, and 12% don't do it at all. You keep the loans where they really are. That's not surprising, as I think in most cases, most banks do have a special assets or loan workout group that automatically assumes responsibility once loans get into that status. So if we could go to the next slide. So as I was saying just before the polling question, we believe that for most banks, the most challenging issues involved in non-performing loans are going to have to do with record keeping. That is how and where to correctly record, store, and track all the additional and more detailed data that problem loans will need, such as new transaction types, incoming funds allocation, changes to balances and valuations, and other miscellaneous information. These issues become especially more acute the more a loan's credit quality deteriorates and requires more detailed and descriptive data and essentially real-time tracking of changes. Will you have sufficient data, for example, to be able to identify and monitor credit problems as they arise? Do you have enough data fields that can be configured to capture and segregate new status information and issue notifications if they're breached? Are there gaps or missing data in a loan's documentation that should be repaired? Collateral will play a very important role in non-performing loan cases, and its valuation will need to be monitored very closely, as it could very well mean the difference between loss or recovery. There can be situations where a loan should be put into non-accrual, not because it's delinquent in payments, but because it's what we call collateral dependent, and the value of the collateral may have shrunk to a level that makes recovery look very unlikely. Payments received are likely to be applied differently if collateral rather than delinquency is the issue. In most, if not all, non-performing cases, keeping multiple balances is the best practice. When a loan stops accruing interest, the real balances and funds application will need to be segregated from the quote legal balance and amounts due that are billed to the customer. We know that many banks may have to rely on spreadsheets and subsidiary systems to record these differences, a practice that we believe is risky and vulnerable to human error, loss of data integrity, and reconciliation differences. Miscellaneous activity, for example, attorney fees, appraisals, UCC filings, unexpected funds coming in from an unknown source, will become much more frequent, and you'll need to have the capability to store them in available and accessible places. Some transactions may need to be split, with data being applied to multiple loan tranches or held in a pending status while permanent placements are decided. Our guidance is that keeping all data and funds pertaining to problem loans in one loan record and all in a single system of record, maintain the full history, continuity, and audit trail is the preferable solution. That way enables greater efficiency and productivity for your operations staff and minimizes the risk of lost data, reconcilement problems, and missing or lapsed notifications. Bear in mind that internal reporting requirements are also going to increase and be more frequent for non-performing loans. This will likely include asset quality reports, non-performing asset and charge-off forecasts, collateral values, and TDR reporting. And finally, the need to maintain data integrity in problem loan accounting and reporting is perhaps even more important in these cases than in normally performing loans. In the era of pandemic, economic recession, mounting loan loss reserves, and razor-thin margins, banks will be hard-pressed to ensure that the data on problem loans is as accurate, complete, relevant, and up-to-date as possible. So this concludes the discussion of potential operational issues for problem loans. But before I turn things back to Dean, there is one more polling question we'd like to ask. So could we move to that question, please? Related to the previous question, we would like to know if your bank typically removes problem loans from the primary loan system and reassigns them to a workout system. So as before, please answer yes if you do that for all problem loans, yes if you do it for only selected loans, or no, you retain your loans on the primary loan servicing system. And we'll take a minute to collect those answers. So I think we're ready for the answers. Wow, 78% answered no, that they retain most of their, nearly all of their problem loans on the same primary loan system. They offload about 17% for a certain selection of loans, and then 6% of the banks offload all of the problem loans to the special servicing unit. This was actually a little bit more than I expected to see, that 78% retain them on the primary system. But it's a good signal that they're keeping up with what we believe are the better practices of retaining them for the sake of history, continuity, and audit trail especially. So with that, Dean, I'd like to turn the affairs back to you for some concluding remarks.
I appreciate those insightful comments that you brought us, and I really appreciate the fact that you worked the word double whammy into your session. I didn't expect to hear that from you, but thanks for setting the stage here for my topics. Which really, when you look at that poll question before about moving loans off the platform, I think the higher percentage is partly representative that probably most of our audience today are using AFS loan platforms, and that is something that AFS has always supported. So certainly with the AFS Level 3 platform, one of its signature capabilities has been to deal with problem loans. So as we've continued to develop more capabilities and develop the AFS Vision platform, we took those features from Level 3 as a starting point, and then continue to add additional enhancements for greater efficiency and for new and future problems that banks will be facing. So certainly our goal is to be able to maintain the loans on the loan platform system of record, not having to move them, move history, lose data continuity, and so forth. So with AFS, you're able to support the single platform model. The recovery process, of course, tracking and reporting, we've expanded the capabilities to track different categories and balances of recoveries, different forms of charge-offs, whether they be charge-off, write-down, some type of litigation amendment or so forth. That can all be done now and supported on AFS Vision with using those balances. And again, the data. As Lee said, data is at the core of all this, having the complete data, and we have extensive data capabilities now in AFS. We've expanded those with AFS Vision, and with the process that we support, we've enhanced the ability to complete the data and maintain the data integrity, how the data flows through the process, how it gets to the system of records. For configurable data fields, we have added a capability now in AFS Vision where you as a client can add an unlimited number of data fields of any type. You can decide if it's a date, an amount, or some other type of record field, whether it appears on workflows, on screens, on reports, on data extracts, so forth. This is all completely automatic, completely configurable by the end user. So while we have an extensive amount of data in our base model for AFS Vision, now we're giving you the ability to add an unlimited additional amount of data for whatever your specific purposes would be. Certainly tracking the different positions on the loan, the different balances, being able to manage the financial transactions so that the money gets applied in the correct place, which of course directs where the monies fall into general ledger. This is all supported in Vision in real time with the greater capabilities for sending to general ledger, doing things like separate cost centers for each fee or each cost, being able to look at GL entries same day as they're generated in real time will greatly enhance your accounting support. The multiple pricing and balance, again, the idea of maintaining a single loan record, and whether you've got pricing options or different charge-off impairment balances and so forth, all being able to be done on one loan record. That gives you greater efficiency in tracking the data, sending it to general ledger, doing the proper financial reporting so that your portfolio managers, your finance group can get very specific data about the impaired loans and about the activity on those impairments. Again, maintaining single loan records allows you to maintain history, additional data, guarantees, collateral, so forth. None of that has to be rebooked or changed or moved in AFS Vision just because the loan becomes impaired. Everything can still be managed in a single place as it was. And again, with AFS Vision being a real-time platform, truly 24/7, then activity is posted, general ledger entries are generated all in real time. Certainly when you reach the end of quarter, when the bank is assigning charge-offs and other classifications, being able to do that, being able to see the results of that activity, those updates on the same day in real time, eliminates the need to check the next day to make sure things are right. It eliminates the need to make corrections with, as you're closing the books at the end of the quarter, end of the month. The real-time processing greatly enhances your ability to manage this and provide better information and more efficiency. And one other thing to mention is that we've been developing, workflows throughout AFS Vision for all different types of common processes, whether it's advances, payments, address changes, whatever it might be. We've also developed a set of credit administration workflows. So specifically, if there's a reason to review credits, as Lee just outlined and Doug said, there's many reasons now to be doing that. There are workflows specifically tailored to reviewing the client's credit status, reviewing risk ratings or credit scores, being able to do repricings, to add fees, changes to repayment plans, deferrals, and so forth, as we said. Whether the credit administration workflow is to review guarantees where you're collecting additional guarantees or additional collateral to support the status of the loan. These are all specific workflows that have been developed. So you can see there's a long list of specific capabilities that AFS Vision is positioned for in dealing better with the problem loan, the uptick of the problem loans that we're seeing. We anticipate that we can take these topics and schedule some additional sessions going forward where we drill down into more details specifically based on your interests. So we're going to encourage your feedback for that. In fact, today, I believe as you sign off, there will be a quick survey. I think it's only 3 questions, but it will help us as far as planning future sessions and where we can go with that. Okay. We have gotten some questions already in anticipation of today's webinar. I think we've weaved them into our material. Mostly today, we had questions about e-signatures and document updates that Lee mentioned, and around troubled debt restructuring, and as Lee said, the 401(3) clause in the CARES Act that has simplified, I think, the need for TDRs. We had a question about certainly the LIBOR transition. What does that mean to the to problem loans? And certainly you're reviewing your credit agreements now to know what language you have to support, changes in pricing if a loan becomes delinquent or becomes impaired. One of the things we've done with AFS Vision, if you're moving to SOFR and you're dealing with the new compounding interest calculations, is giving you an ability to not have to rebook loans if an impaired loan has to move from LIBOR to SOFR during impairment. With our multi-balance capability, you're able to change that pricing from a simple interest LIBOR pricing structure over to a SOFR more complex compounding structure. So these are some of the things that AFS Vision will provide for you, which will greatly increase your efficiency in managing these problem loans. I'm just checking. I don't know if we've had any new questions. I think I've dealt with the ones that I've seen. If we can go to the next slide. Just some of the upcoming topics, again, with our work with the RMA, we will continue in our series of risk analysis webinars. Certainly our CCAR benchmarking that we have. we will anticipate another webinar on this topic or other topics deriving out of today's webinar next month. And then again, another risk analysis webinar, and you'll see the quarterly pricing dashboard in November and our November risk analysis service webinar as well. So you can see we're staying very active, being responsive to the market. As always, we appreciate your feedback. And if you have any other specific topics, let us know, or any other specific questions that we can work into our future webinars. We will certainly do that and continue to be a responsive vendor for you. Renee, you want to go to the next slide? Again, you can reach out to us, certainly through your RM, through your own personal contacts at AFS. Certainly a reminder to go to our website, our Facebook page. You should be able to sign up for Twitter updates as well. We are available in all different areas of social media, so we encourage you to stay connected with AFS in many different ways. Renee, would you like to close things up for us today?
Sure will, Dean. So we would like to thank everybody for attending today. And as a reminder, we will be sending you an email tomorrow with a link that you can listen and download this presentation again, or share with a colleague that may not have been able to join us today. So thank you all very much, and everybody have a great day. Thank you.